All right. Looks like we're live. Audio looks good. Signal looks good. Okay, I think everything's good. All right, welcome everybody. Midas Investing Live. Been a few weeks. 2 weeks would have been last week, so technically missed a week, but whatever. Still here, 3 weeks on. Gonna be probably a relatively short show this week. Just gonna kind of be some of the brief update, discuss some of the things I've been working on or planning to work on in some of the near future. It's definitely been a very busy last few months, honestly, for me personally and in my professional life. In sort of a good way. My personal life has been sort of hectic because I've been working so hard at my professional life and I've been busy there. But things have been kind of going well there overall. I think I'm sort of getting the hang of the new position that I started 4 to 5 months ago, um, which is good. So that means I'm kind of bringing the rest of my personal life back into order, I guess you could say, which hopefully means that I can also do a little bit more of a lot of the projects and ideas that I have for investing. I can hopefully spend more time on them because frankly, I just haven't been able to spend as much time as I would normally have like after work and on the weekends and stuff, doing various ideas because I have all sorts of ideas. But and it's not that I don't have the time, it's that it's hard to find, I guess you could say, the willpower and drive to spend the time on it because I'm just like so focused on other things. But either way, kind of a long vague way to kind of explain why I haven't done as much stuff in the last few months, but I have all sorts of ideas, which we're going to discuss some of those here today, and how things look in the market right now. Here, something, handful of days, like a week ago or whatever. At this point, we had the ceasefire in the war in the Middle East and the Strait of Hormuz. There's already been all sorts of tensions about how real the ceasefire is, or how even realistic the ceasefire is, or whatnot. So I know whether you want to say there's actually a ceasefire or not is kind of a somewhat of an open question, a little bit of a debate. I think the latest headlines I saw was that now the U.S. is planning to do some sort of blockade or something like that. So crazy whatnot. But I mean, let's go over to the looking at kind of the market itself. Obviously, we had the big rebound on the day when that was announced. You can see here, yeah, big old gap up, big rebound, and then somewhat of drip up over the last few days since then. So you can see, yeah, we're really only a few percentage points below where the peak level was, but we're still down from there. But we're more than halfway back up to where the peak level is. So that's already pretty substantial in and of itself, you could say. But like I said, there's a lot of people have their doubts. A lot of people have their doubts as to the ceasefire itself. So we'll see about that. And also, if we were to look at oil, obviously oil's come down a little bit from, we were kind of in the 110s, 115 kind of range or so prior to that, and then we did have a big drop down on the announcement. So now back down to 95, 96 kind of level. Which is still high, quite a lot higher than it was only a handful of months ago, but it's in a sustainable range, I would say. A lot of people kind of debate exactly like what the sustainable range is for oil, and honestly, the sustainable range for oil, I would say, is pretty wide. But a lot of it has to do with how quickly you get to that level, because oftentimes when we get to these highs and these lows in the sustainable range for oil, you get there very quickly, as you can see here, like both on the upside and on the downside. You usually get to those extreme levels very, very quickly. And that's actually, I think, the thing that makes it unsustainable. If you had a little bit of a grind upward, I think it's more sustainable. In fact, like, for example, I would say like here in the period from 2009 to 2014, I would say is somewhat of an example of that, where you can see like it did go upward, and got pretty high here, went up into the 110, 113 or so, and then kind of came back down to 76 and kind of stayed up here in this kind of like 90 range, similar to where we are now. And it did a little bit of a slow grinding for several years until eventually there was a production and supply glut going on over here, and that's what caused the crash here. So that was you know, somewhat producer and supply driven, a whole different thing on the downside. So a different situation. But the point is, like, the fact that like you had it high up here for this multi-year period, I would say like the fact that it kind of moved up slowly is one of the reasons why I like that you got for that. So that's what I would say is that, you know, if you kind of stay where we currently are at 95, that is definitely at a level that's not likely to really cause a recession here in the US. It could cause some recessions in certain economies elsewhere around the globe. But even like a global recession, I don't think that's necessarily the levels to get up there. Once you're kind of like up 100, 120, up in that kind of range, then it's really starting to, I'd say, be a big drag on the global economy. But even at that level, I would say is probably not that breaking for the US economy, because of the fact that we're such a big producer ourselves, more on the natural gas side of things, but significantly of oil as well. But the point is net exporter of petroleum products on the whole, which kind of tamps down the local prices here in the United States, and also how the effects it has. Yeah, like, yes, obviously, gasoline has gone up quite a lot, and everybody's feeling the pinch in their personal wallets. But the truth is, like, I've seen plenty of charts of the data. I don't have the chart of the data in front of me here to show you guys, but if you look at like charts of how much the energy, gasoline, or whichever like slice of the data you want as a percentage of average consumer spending, it's much lower than it used to be compared to the 70s or the 80s, or even just a couple decades ago. Like I said, partially because of supply changes globally, but and then also major supply changes in the dynamics of the United States' ability to export versus import as well. So yeah, in oils come down a little bit, like I said, due to the ceasefire, but a lot of people think that the ceasefire may not last, so it could go back further higher. But basically, a long way of what I'm trying to say is that I don't think these levels are necessarily breaking. I do think there's some big questions about the energy stocks themselves, because a lot of them had already kind of priced in some higher levels. I know I had talked about that. I don't really want to bring them up necessarily, all of them right now, but I had sort of talked about that back when we had the kind of $60 oil prices, and I was talking about it, and I was saying, hey, this is the time to hop into energy stocks if you are interested in that. I did point out that a lot of the larger majors had not corrected nearly as much. And so essentially, that because they had not corrected as much, that meant that that didn't leave as much upside for some of those. Okay, actually, I guess I am gonna bring up some of the majors to make my point. I will bring up these three, mostly because Chevron and Exxon are the two largest US majors, and then BP is the one that I was saying that I kind of liked the value a bit more of myself. Actually, hold on. Let's bring these over to the same scale. Yeah, so oil is up like 64%. You can kind of see since roughly around December or something like that time frame, whereas all of these stocks you can see are up 28, 26, 27, 20, 29% for Chevron and Exxon. I will point out that BP is up more. So, you know, that's somewhat goes to what I had said before, is I liked the valuation of BP a bit more at the time. I did also say that I thought that you couldn't necessarily, that it was somewhat of a couch decision on BP because they were European. So you could have made the argument that they deserve a lower valuation, that you wouldn't necessarily ever get that premium there. But nonetheless, depending on like when you buy, as you see, like you can kind of like move the time frame around, but depending on where you bought from, on most time frames, yeah, really like most time frames, there's really a few spots in there where BP wasn't the outperformer, but basically all through last fall up through January, one, obviously any of these three stocks would have been good, but BP would have been largely the better one. But all three of them largely underperform oil. That is kind of the point I was sort of bringing up when I brought up was trying to bring up all of them in general, to say that obviously energy, like as I said, the stocks themselves had not corrected as much as oil did. So when we get this whip back up higher here, unfortunately, it doesn't quite give as much torque. So if there is going to be upside in oil, because maybe, for example, the Strait gets proper close, because we did have a couple weeks of like proper closure, but then we had like a couple weeks of partial closure with like Iran allowing certain ships through as long as they were kind of paying the toll. And then now, like I said, there's some sort of discussion about a blockade or something like that. So who knows what the terms are going to be? But the point is, like, so far it sort of seems like we're going to be having this like sort of partial closure thing where there is ships getting through. It's just ships going to specific locations. Most of those locations being quote unquote enemies or non-friendly nations to the United States. And then those nations are paying tolls in order to do so. So, and largely I'm talking about like to China and stuff like that, or in India. Well, I guess India is not necessarily like an enemy non-friendly, but they're, you know, not necessarily a super ally per se. But, you know, point being, non-Western countries, they're not going to Europe. That's definitely one of my points, is that a lot of the oil is not going to Europe. A lot of it's kind of moving further east and paying certain tolls for it to get there. And then it's relatively a trickle even compared to the flows prior to the conflict. But the point is, it's not entirely closed. So we could still have an even larger disruption. And this price right here isn't really pricing that in. So that's kind of like the big question of it. And also, it's worth noting, I am looking at the WTI oil, because there is also the discussion people have talked about over this conflict, that there's Brent versus WTI. I would typically like to look at Brent, which I mean just goes to show my my American bias, I guess you could say. But and WTI is going to be the price that is most relevant to the American consumer and how it filters into prices there. But the European Northern Sea price, which is the Brent price, is the prices used in a lot more international transactions. So it's one thing that's worth noting about that. And you can see that for a lot of the conflict, it had a huge premium relative to WTI. You can see that that premium has come down though pretty significantly, which is sort of a sign of less stress for the European market getting the supply. Obviously, the question of what price they're going to get is a different thing, but whether they're actually going to get that supply, it's somewhat cool on that front. Obviously, that isn't to say that the conflict is going to have no effect, though, because we still will have follow-on effects to the things that require the energy markets. I've heard a lot of people talk about the food markets, and because of the fact that a lot of the fertilizer supply, the urea fertilizer supply that comes out of the Strait of Hormuz isn't making it to its destinations that it was supposed to be at basically by like this point, because you know ships that were supposed to leave you know a month and a half ago would have been getting there a week ago or 2 weeks ago, and so there's like maybe even a week or two delay you could have had on there, so it could have been arriving sort of at this point now. And so there's crops that are not being sown now that are not going to be able to be reaped, you know, 6 to 9 months from now, which means there's food that's not going to be hitting markets 9 to 12 months from now, which means there's going to be rising food costs over time. I've heard a lot of people kind of talking about this narrative as well. I will point out that that was also part of the discussion back during the beginning of the Ukraine crisis as well. I talked a lot about this as well. It actually took a position in one of the fertilizer companies, Mosaic at the time, which did not work out very well for me for a variety of other reasons. But nonetheless, people were talking about the potential for a bit of a food crunch because of how much of the fertilizer and wheat production came out of Ukraine. So sort of a similar dynamic, but different countries in different parts of the globe that are kind of causing that pinch. Now it's energy markets kind of impacting the fertilizer markets. But yeah, so I will kind of point that out because that narrative is going around right now, and it's definitely a potentially very real narrative. But that narrative also was going around back in 2022, and it did not necessarily materialize. And that's not to say that the risk wasn't there. The risk is here now, and the risk was there in 2022. It's just certain things did manage to mitigate a lot of that risk comparative to some of the most catastrophic scenarios that were talked about at the time. So that could potentially happen here again. But like I said, we'll keep an eye on it. Let's see, like, for example, wheat prices. Yeah. Wheat prices have been here. Oh, well. We get a... I don't really look at wheat prices a whole ton. So, you know, I did back in 2021, 2022. So obviously here, like looking back, you can see like going into the crisis, we already had rising oil and wheat prices due to just kind of the inflationary kind of wave that we were going in post COVID, obviously, but then we had the crisis in Ukraine spike up, and wheat prices spiked up pretty dramatically because, like I said, there was a little bit of a direct one-for-one effect of it because Ukraine specifically produces wheat, whereas now it's not as one-for-one, it's more of a derivative effect. So you can see there's been a spike up in the price, but not nearly as large of a spike up in price. Well, actually, okay, I shouldn't even really say that because technically here in percentage terms, it's kind of similar. Here you can see it's like 50 up to over 100. So that was like a 100% jump. And then here you can see technically it's like at 10 and it jumped up to like 2021. So technically it is like a very similar jump up in percentage terms, but in nominal prices, we're still way, way, way lower. And that's because food commodity prices do tend to be very, very quick to deflate due to production efficiencies when there isn't inflationary waves going on. So that's why once the fiscal tightening kind of like set in the second half of 2022 and 2023, you can see a lot of those prices were coming down even faster than the energy prices were. So yeah, you can see a bit of a spike up price here, but again, it's more of a follow-on effect that would lead to wheat prices going high. It's like first you have oil prices getting high, and then you have fertilizer prices getting high, and then you have wheat prices getting high, and it takes several months for that process to kind of feed through. So yeah, that's what I would say is like maybe like try to keep an eye on wheat prices every couple weeks or every month or so. Maybe try to remind yourself to take a look at wheat prices and see what's going on there. And I mean, you don't have to do just wheat. I mean, you could look at other ones like corn or things like that. But I think wheat's probably one of the more generic, easy ones to do. And you could also just look at like agricultural basket generally. I think DBA is it? Yeah, agricultural. It's an agricultural product fund here, which includes a lot of different things like corn, wheat, barley, soy. It's like it's a whole agricultural basket here. So that's why, as you can see, like it was kind of already relatively at highs, even going into this crisis here, because you see through 2024 we had some pretty big spikes in prices, and they kind of flattened out for a lot of 2025. And then here you can see at the beginning of the crisis it started to move upward, but that move upward on a kind of relative percentage basis from here is much smaller. Now it's only like maybe like a 10% jump up in price because wheat is probably only so much of a component in the basket. But like I said, that fertilizer effect we're talking about will impact a lot of this basket. So actually, yeah, DBA is probably a better thing to focus on than just wheat specifically, because it'll capture it a little bit more widely. And I'm looking on separate scales, but putting them. Oh, no. Whatever. But yeah, so just things to keep in mind, things to pay attention to. So with that in mind, because while I'm kind of thinking about that and prices rising, we did also get the inflation print this week. Or well, first actually on Thursday, let's talk about. Now, first Thursday we got core PCE prices in, but really that's not really the big part of the discussion. And actually before I go any further, since I'm so bad at remembering this all the time, if anybody's watching live on the replay, please do like the stream. It'd be really, really appreciated. Help us attract more viewers to the channel. Like the stream, subscribe to the channel if you're not already. Please consider joining our free Discord. Links in the description and below. Also, pinned comment in the chat. And come be part of our Discord. I do have to manually let you in, so if you do jump in, you'll kind of land on this landing page here where you can't really see anything, and you can ping me or a moderator to try to let you in, but we do kind of try to filter out spam and things like that, so it takes a little bit of filtering before people get in. But if you're patient, you can enter our free Discord where we have conversations of things going on in the markets, share things we're doing in our own portfolios, actions of major investors, research, memes, things like that. So come be part of our little group there. But yeah, so trying to remember to do the YouTube things every once in a while. But anyway, so yeah, on Thursday we did have the core PCE prices, which came in largely even with where they were. The month over month change previously was 0.4. We got a 0.4. It was 0.4 expected on the year over year The year-over-year level was 3%. It was 3% expected. It was 3.1% previously. So, we're still kind of hovering largely in that range. But again, this was for February, the core PCE, because that does tend to be a little bit slower than the actual CPI measure. But on the same day, we did also get the final GDP numbers for Q4, because GDP numbers are reported 3 different times, with our initial estimate, a second estimate, and then a final estimate as they kind of update the numbers. So we did get the final estimate for Q4, which was revised down. Where is it? Growth rate Q4. Here it was expected to be 0.7%, and it was down to 0.5%. I think the previous estimate was like, what was it, 1.3% or something like that, and I think the advanced estimate was like 3.2 or something like that. So it was a pretty strong progressive downward move across the 3 estimates, and the final estimate for Q3 was 4.4, so a pretty big deceleration in Q4. It is worth noting that Q4 did have government shutdown in it, so that is going to be a significant impact there. And I think I saw some officials make estimates that it was probably like a 0.5 to 0.4% drag or something like that on it. So if you were to like add that back, that would maybe be like 0.9 to 1.0 maybe, is kind of what you would maybe have had if the shutdown didn't occur. Still kind of slowish growth, but that at least kind of like makes it seem a little bit less close to negative, but nonetheless still weak on that front. And I've talked about it many times all throughout the last year and a half that well, I talked about this mostly in the context of the employment numbers, but I talked about like kind of the fact that we had the change in the immigration policy. We've had a shutdown to the increase of immigration coming into the country, and then obviously we've had significant amounts of deportation. So that's like a huge change to the overall employment supply, which has had a change in the overall employment numbers, but that is also expected to have a nominal slowdown in growth, because it's just less bodies in order to engage that growth in. I've talked about that at multiple fronts. We are also kind of in the context of a productivity boom at the same time, so that's why we kind of having these like swings back and forth between kind of weak growth and strong growth is sort of like what we've been experiencing. And I think that we're probably going to continue experiencing that kind of thing, because I do think that in some ways we do have kind of cross currents going at each other in that sense. So like here is multiple measures kind of like expected GDP that I like to look at. Well, first, the green number is the actual real GDP quarterly compounded measure. This is the headline measure of GDP that is reported. Like for example, here you can see it is the 0.5 that is reported right there. So that is the actual GDP as it comes in. And then this GDP now model comes from the Fed and is based off of a bunch of data inputs as it comes into the Fed. That's why they call it GDP now. So they literally update it like every single week with new data that has come in. So like they already have a point in here for Q1, but that point, the data, like it currently shows 1.1%, but like a week from now it might show slightly higher or slightly lower. And then there's also the red line, which shows the St. Louis Fed news nowcast GDP, which is kind of a similar approach, but instead of using hard data that comes into the Fed, it's actually using news reports and like the wording and headlines and stuff like that. So which can be indicative of growth. Like it still correlates pretty well with GDP, but it is not as correlative as the GDP now model, I find, because it's basically a sentiment gauge. The sentiment gauge that is not bad, because it's still it's the wording of the headlines based off of the reporting of the actual data, but nonetheless it still includes like the wording that the reporters chose to use, right? So there's like a sentiment effect in there. I mean, I kind of have talked about this, I think, at various points before. I like to kind of compare the two, because like if the sentiment one is much lower than the GDP now model, it kind of implies to me that we might have significant surprises to the upside. And you can make the argument other way, that if the sentiment model is showing higher than the blue one, then it means that maybe you could have significant surprises to the downside. So I'll point that out for Q1. We currently do have that showing that, where the sentiment gauge seems to be showing slightly more positive than the actual data gauge, but not by a large margin. You see they're both pretty close to each other at like 1.3 to, I think that one's at about 2%. So 1.3 to 2% is currently what those two models are gauging, and I do think those are probably the best out of these measures I'm showing here. I do also have this yellow line here, which is the Lewis Merton's weekly economic index. It's kind of a somewhat, I guess you could say, a mixture between the two. It uses both sentiment based information, but also hard data. And it's not made by the Federal Reserve. And as it shows here, it comes out on a weekly basis, but they don't update it. It just has like one data point for each week, which is why it's a little bit more zigzaggy and less accurate. And then there's also the Federal Reserve's annual projection, the median projection from the Summary of Economic Projections. So different measures of like where expected GDP is going. It's, like I said, for Q1, between like 1 to 2%, it seems to be the current projected level as of the last week. As I said before, it does update with new information pretty much every single week. So, well, that's kind of like the context of where we are with GDP. We'll see what happens with that. Obviously, I will point out that higher oil prices is going to be a drag to GDP. And so these current projections here, both the sentiment one and the database one, are taking that into account probably to a certain extent. In fact, that might explain why the GDP Now model is lower than the sentiment based one, because honestly, the headlines, when they're reporting that information, they probably aren't going to be able to take that second, third order effect into account. Like they do tend to be very negative news headlines, but they're not economists, so they might not be negative in the most intelligent way, if that makes sense. So like they actually probably wouldn't be able to account for the fact that oil prices are going to have that kind of drag to the normal data. They will still talk about oil prices being bad, but not in a way that this model would pick up, is basically what I'm talking about. So that might explain kind of the drag we're expecting for GDP in Q1, but it'll be interesting to see. The Q1 obviously just ended a couple weeks ago, 2 weeks ago approximately. So we won't really get the GDP number for that for another like 3.5 weeks or so, midway through next month, about a month from now approximately. So yeah, we'll see what happens with that. And like I said, that was Thursday. We did also get consumer spending and income data that day as well. I don't usually focus on that data as much, but a lot of certain economists have kind of implied to me that I probably should. So maybe I'll start to pay more attention to it, but I don't have a whole lot of context for that here today, other than to say that here you can see the consensus was 0.3% and it was negative. Spending came in as expected, and then like I said, the real most important part of the data from this week came out on Friday. So we'll talk about that part now. Jonathan, hey Midas, stopping to say hi. I'll watch later. Thanks for the content later, guys. I appreciate it. Yeah, it's probably going to be a bit of a shorter show today. Just kind of doing some quick update stuff, but I appreciate you stopping by. Thank you. Have a good day, man. But yeah, so on Friday, we did get the CPI data though for March. I did kind of post in the Discord about this prior to that, because I did think it was potentially going to be a big reaction. We didn't really get a huge reaction on Friday. I'm coming over to here. You can see obviously like Friday was down day, but kind of muted. It wasn't like a huge reaction. Obviously we had the big jump up already, but that's because honestly the way the potentials for it to turn into a more big reaction didn't really materialize. We had potential for a big reaction due to the CPI print, but it kind of depended on what happened. And honestly, we came in kind of right in line, or in arguably slightly better in line than things could have had been. So the muted reaction was appropriate. So what I had actually kind of spelled it out, so I'll just read what I wrote here. I said, be prepared for the reaction to the March CPI numbers tomorrow, which will probably be a big driver. Headline is expected to jump from 2.4% in February to 3.3% in March. Big jump, but largely irrelevant because it'll be in the past and shock driven. So yeah, we were expecting a big jump in the CPI print, which we can see here. 3.3% was what was expected, and we had previously been 2.4%. So we came in exactly as expected. So in this post, I sort of assumed that we would come in as expected, and I said that was largely irrelevant. So yes, 0.9%, big jump in the CPI, but the thing is it happened in March, right? So it already happened, and it happened again almost 2 weeks ago at this point. The real question is about what's going to happen in the future, and what we worry about instead is core CPI, because core CPI, which takes out food and energy costs, that is really where wages and services costs tend to lie. And the real question is whether or not the increase in oil prices is going to cause increases in wages and services costs, and so seeping into the core measure. And that was really the big question. So here in the core measure, for example, we were expecting a jump up of 0.3% compared to 0.2% last month, and we got 0.2%. So we actually came in slightly cooler on the month over month change relative to the expectations by about 10 basis points. So came in as expected on the headline measure, 0.9%, but 10 basis points less on the core measure. So still upward movement. And then on the year-over-year rate, obviously, like I said, was 3.3% for the overall measure, but for the core level, it was 2.6%. So we went from 2.5 to 2.6%, or versus 2.7 that was expected. And so the reason why this matters is because, like, big jump up in the headline measure matters, but as I've kind of talked about, it's like the oil problem is basically just going to last as long as the conflict lasts. Like once the conflict really starts to resolve, oil prices will basically start to collapse down, because they're in the meantime, people are going to be pushing to get more supply while the conflict's going on, while prices are high. But then once the conflict's over, the restricted supply starts to come back online, and the new supply now has to compete with the restricted supply, which means now there's a glut of supply, which causes a crash in prices. So the point is, we just don't know when that's going to occur. That could occur in the next month or two. That could occur 2 years from now. Again, going back to the Ukraine analogy, we had a spike up in oil prices in January, February. And then they remained pretty high and really kind of reached their peak levels on kind of weak ending prices in June 2022. Their overall peak prices was only in March 2022, but still, like, see, like it was like a 6-7 month period of like really peak levels, and then the price started to come down. It was still relatively high for going on through till basically a whole year had passed. But then going into the second year of it, prices were back down to kind of much lower levels. And again, the Ukraine conflict is still ongoing, right? So, and the reason why this happened had to do with cutting off of Russian supply, for example, because they're a huge producer of oil themselves, and a lot of that moves through Europe, which comes across Ukraine or across areas nearby and adjacent to Ukraine. So you can similar dynamics. It's a lot of differences, but a lot of reasons why things could be similar. So like looking at this spike here, maybe it lasts for 6 months, way up here or something like that, and then maybe it kind of like starts to dwindle down over the next year or two, right? Like you could see a similar type dynamic. You could also see it easily go up higher and technically kind of double from here, and then doing that process, which kind of means that it's maybe going to take twice as long for it to come down, because it might be twice as high in a more disastrous scenario that just hasn't fully unveiled itself yet. So I'm not saying that we couldn't still get a much higher oil price. I'm just talking about the eventuality of it coming down and what that means for those prices. So again, coming back around to how that plays into the inflation numbers, is that the expectation with oil shocks generally is that they are temporary. Even if it might be for 6 months, a year, they are still temporary one way or the other, which means that the Fed doesn't really want to react to them, because if you start hiking rates in response to inflation going up now, then by the time that the oil prices come down, that means that's going to add deflationary pressure to the inflation numbers, because it's going to be positive to inflation on the way up in the same way that it was positive to inflation in March here. It's going to be negative to inflation on the way down, whether that's 6 months from now or 2 years from now or 4 years from now. One way or the other, there's going to be a wave of deflation in the CPI numbers, in the headline CPI numbers, one way or the other. And that's why the Fed wants to ignore the headline CPI numbers, and they want to look at the core numbers instead. And obviously the Fed prefers core PCE instead of core CPI, but core PCE and core CPI are at least, measuring kind of in the ballpark of a similar thing. So it gives you a similar idea. The core number here is similar to the core PCE. So anyway, the point is this was good. This was good here on Friday, what we saw. The fact that it came in less than expected. It was still an increase from 2.5 to 2.6 on the year-over-year number. But I mean, okay, whatever. Looking at the, looking at like the last period here, it's like 2 points ever since November, 2.6, 2.6, 2.5, 2.6, 2.6. That's what we're talking about. It's like it's kind of hanging out in the same level here. And I will point out, obviously, we had the government shutdown here, which is why we have the missing bar here for all numbers coming from the BLS, which includes the CPI number. And I did take a look at the methodology. Essentially, what they did is they basically just left a 0 in the index for here. So I will admit there is kind of an artificial down movement due to the government shutdown in the CPI number right here, which might revert back upwards once we reach the basing effect out of it, which is going to be in October of this year, 2026. And I estimate that effect to be about 30 basis points or so, which you can see it went from 3% down to 2.6. So that was a downward movement of 0.4. And I'm basically arguing that about 0.3 of that is literally just them not having the data for October. So in my opinion, there is basically baked in the cake an increase in core CPI in October to November of this year of about 30 basis points on base effects alone. It's worth noting. So even when you look at this 2.6 number here, you should almost automatically look at that and see 2.9, in my opinion. Like you should just assume that that's 2.9 and assume that, like, you can see how here we were at 3%, 3.1, 3.1, 2.9, 2.8, 2.8, 2.8, 3.1, 3.3. Like, I would just kind of look at this trend right here and just say it kept going relatively flat. Like, this downward jump you see right here is kind of artificial due to the government shutdown. I'll point that out because I don't think I talked about that too much at the time, but I did do some modeling on the CPI data and came up with the conclusion that, yeah, about 30 basis points. The core CPI number right now is about 30 basis points lower than it ought to be, and we'll revert out of it eventually. But anyway, either way, even with it still up at 2.9, it's still flat at 2.93%. And 3% is still higher than target, but hey, it's hanging out in the same level that I've been saying CPI has been bottoming for like the last 2.5 years. Like I was saying back around here when we were at like 3.8, 3.7%, when we were like closer to 4 than 3%, I basically said that we would probably get to 3% and not really go much lower than that. Like I did say that many times on stream. So if everyone will remember, I did all sorts of modeling on it and was basically came to the conclusion that our kind of like core CPI level or our core inflation level that's just kind of in the US economic system right now due to our deficits and our overall level of money printing for the last 5 to 10 to 15 years, basically just gives us about 3% inflation right now. So that's kind of why, in my opinion, that's just more evidence of that, to be honest. So yeah, anyway, the point is, either way, getting back to this though, this was good, a good sign that showed that the oil prices are not particularly seeping into the CPI. Like, yes, we're stuck around 3%, but we're not stuck around 3% and maybe going to seep higher to 4 to 5% in the core number because of oil prices. Now, if oil prices do, like I said, if they do stay here for a whole year or maybe even double from here, then we'll have to reevaluate those core measures as they come in month by month. It's not like 1 month, one print of this here in March ends the discussion, but nonetheless, this was a very important data point for the market. And like I said, we had a muted response, but that's because the reaction was good. The thing we got was actually sort of good, and it was technically a down day. So technically, with what I would have called moderately good economic news, we had a down day in the market. So, that's its own separate thing. But obviously you could maybe point to other things, something going on there. We did have yields up, for example. So, there's obviously other things going on. It's never just one factor. Spent a lot of time talking about GDP growth and inflation when I titled it talking about liquidity and credit. So I didn't really even talk about that as much as I wanted to. But I will talk about that here a little bit still. I have put together some different liquidity measures, or well, really, these aren't really new. These are liquidity measures I kind of already had, but I put them in TradingView, which has kind of allowed me to do something that I haven't been able to easily do before in spreadsheets, which is get the conversion to dollar currency at an easy level. And then also in TradingView, that means that even if you convert to things to a dollar that reports itself on a weekly or monthly basis, in TradingView, I can do it on a daily basis for the dollar conversion. And so I'm talking about specifically for economic measures like the money supply or the Federal Reserve balance sheet and things like that. So for example, here, this is my measure of net Fed supplied market liquidity, which is basically like the Federal Reserve balance sheet plus a few other measures added and subtracted out of it So this is like liquidity that the Fed has pumped into the markets, and it acts as like a buffer of market liquidity and is a good kind of leading indicator for liquidity. And here I can show it on a daily basis rather than just on a weekly basis, which is when the data actually reports, because of just like the way the charting is done here in TradingView, which is kind of neat. And I've done that with this on a kind of a global level. So this is for the United States, but then here is kind of like a more global version of that measure. And then because I'm doing it with global, which means I'm using other foreign central banks, like the Chinese central bank, the Japanese central bank, and the EU central bank, I can convert those into dollars using the dollar index, and then get that on a daily basis as well. So you can see these measures here. And then, so like that's market liquidity, like I said, US market liquidity, and then foreign market liquidity. And then kind of doing the same thing, I also have foreign economic liquidity, which is basically is that market liquidity, but also with the money supply added in there is kind of like how you would measure that. And I don't really show the US economic liquidity, because that literally is basically just the M2 money supply. And I mean, I can easily show those, like this is the M2 money supply, right? So like here you can see it has been increasing over the last like few months, the US economic liquidity. But then again, coming back over to charts here, this is global economic liquidity, also been increasing pretty significantly, and it's actually really started to take off since 2025, which kind of it comes back to a lot of the strange dynamics last year having to do with tariffs and a lot of capital moving back and forth, and people deciding how much capital they wanted to keep in the United States after the tariffs were put in place, and a lot of the erratic behavior of our president, which in many ways, like a lot of people were promoting the erratic behavior of the president here in the United States, but in many ways that erratic behavior kind of played into a lot of the stated strategies of the administration, and that being getting capital to leave the country, because that capital is the balancing act of the trade deficit. So we actually haven't managed to improve the trade deficit, not dramatically, not as much as the administration would like, but we have improved the trade deficit, and we have improved the deficit on the whole. And a lot of that has to do with foreign liquidity basically performing in the way that it needed to. So like here, this is like foreign, like I said, economic liquidity, which you can see peaked back in the beginning of 2022 when the tightening cycle began. And you can see it never really got back above this level. It kind of tested back above these levels in 2023 and 2024. And it really only finally started to properly break out and then grow on a global basis again in April 2025, which was Liberation Day, which is just kind of an interesting dynamic there. And then it really started to break out here, kind of going upward. Again, this is global economic liquidity, but it's looking at the global market liquidity. It's sort of a similar dynamic, but not quite the full same breakout, where here you can see it peaked back in 2022, had been coming down, but it wasn't flat and not breaking out. It was actually in a downtrend. And then it finally managed to break out of that downtrend in April 2025. And now it's not at least growing, but it's at least flat, not continuing to drain, because this drain is a negative to those markets, the foreign capital markets, and then the lack of growth in the economic liquidity is negative to those foreign economies. And so now, ever since April 2025, foreign capital markets have at least stopped downtrending, and they've actually started to at least do better again. Like, for example, coming over to here, I have the foreign stock, ex-US foreign stocks, and you can see they started breaking out in June 2024 a little bit, or at least they were started breaking out in June 2024, but then they were kind of retesting several times again ever since April 2025. Boom, just absolutely taking off like a rocket. A lot of that is, again, capital leaving the United States and going into foreign stocks, which is then like I said, halted the decrease in this line here, and then the decrease in this line here. That capital going into stocks in their case has actually then caused their economies to perform as well, which has then caused this economic indicator to move upward. Like I said, a little bit of a complicated thing when looking between all these measures, because a lot of them kind of add into each other. Like I said, this is a the Chinese economic global liquidity, but also the Japanese and the EU. And I can look at each of those individually. Like here's, for example, China, and you can see like China has been almost just like a straight line upward. There hasn't even hardly been a deviation downward, to be honest. Like there was some little like here's again that beginning of 2022 year period where a lot of those time series started dipping downward. And like, yeah, there was a dip downward here for a few months, but then it went back up and retested a few times. And then really ever since like 2023 has just continued on upward for the most part. But then the EU has really had a lot of difficulty getting back up as we've talked about. But then ever since March to April 2025, you can see their overall liquidity profile has started to recover. And then I know I've talked about Japanese liquidity many times before on the channel, but I usually talked about it in isolation without comparing it to the other ones. But this, as you can see, Japanese liquidity is a totally different profile, even still. And this is exactly why I've talked about them so much before, is because they are a completely different negative to their own approach, their own economic liquidity. And that's because their liquidity leaves their own economy and then floods back into the US economy instead. So here you can see ever since the end of 2020, their economic liquidity has literally been draining overseas. And that has to do with the way that they devalue their currencies. Again, because this is priced in dollars. And so because of the fact that this time series is priced in dollars, when the Japanese devalue their currency, that means they devalue it in dollars and it causing the time series to essentially collapse downwards. And that's because there's many more yen, and those yen can purchase more dollars. And then that means that capital is flooding overseas out of the Japanese economy, which in many ways is sort of good for them in a weird way, because otherwise they would probably be having large amounts of inflation, but kind of a complicated topic. So anyway, I spent like 30 minutes now, or I don't know how long it was, this whole spiel of me explaining these different time series, but that was to get around to the point of like what I'm talking about. And what I really wanted to talk about is that ever since this war began, there has been a little bit of a short drain on liquidity. Now, in last fall and into like December, I was talking about the drain in market liquidity here in the United States, and here in this Fed supplied US liquidity measure, you can see what I was talking about here in August 2025. The reserves in the banking system in the United States was plummeting like a rock for a while there, until about November it started to stabilize, and then it really started to recover after December or so, going into here and whatnot. So like looking at other measures here, as I talked about, ever since Liberation Day, the kind of foreign market liquidity has been performing relatively well ever since up until about the beginning of March, which is when the war began. And then we had a pretty quick, tight contraction in the market liquidity globally, which also was showing up in the economic liquidity, which makes sense when you think about oil, right? Like you need dollars to buy oil, and oil is largely a non-negotiable. So when oil prices go up, that means that people need more dollars, and that means that there's less dollars available. And they, by the way, they need those dollars economically. So that means that there's a drain on the economic liquidity. And because there's a drain on the economic liquidity, but they still need to do all the economic projects they have and pay for all the oil, that means that there ends up being a drain on market liquidity. So we were having a bit of a drain on market liquidity. And honestly, I probably would have been sounding the alarms on it a little bit more up until we had, like I said, the ceasefire here in the last few days. And then you can see it started to recover a little bit. But again, getting back to, as every time I brought up the ceasefire so far this stream, it seems very tenuous at best. And it definitely seems probably more likely to fall apart than not. So this is something to keep an eye on. And obviously, like these measures, these like specialized time measures that I've put together for liquidity, you can't necessarily look at very easily. But what I would say is like the easiest proxy to look at in general is the dollar index. I would say look at the dollar index, because as I've talked about this many times before, the dollar going up is a drain to liquidity, and the dollar going down is liquidity being supplied to the markets. Or think of it this way, because the dollar itself is the liquid instrument. And so if this is the price of the dollar, if the price of the dollar goes up, it means it's harder to get dollars if you need them, which is what liquidity is, getting dollars when you need them. So as the price goes up, liquidity goes down. As the price goes down, liquidity goes up. So I would say pay attention to the dollar index. If it looks like it's really starting to spike up, especially like above the 100 level, like we've kind of been ever since the new administration put the tariffs into effect, we kind of came back down to this 100 level and have been kind of trying to get test dropping below the 100 level. But as you can see, we've kind of just hung out here around the 100 level or a little bit below it. And so if we like proper breakout above the 100 level in the dollar index, that would be a big warning sign to watch for the markets if it sustains over like, you know, a multi-week going into a month-long period. It's like the longer and longer and longer that stays. Like if the dollar climbs and climbs and climbs and climbs and it gets back up to like 105, you know, things like that, like we would probably be headed for a huge correction if that was the case. But likewise, it's on the other side of it too. The dollar coming down would be sort of a good sign too. And also, I would point out, obviously, because at the same time when we were having this drop in the dollar, a lot of people were pointing into it and saying like, look, this is the collapse of the dollar. Nobody wants the reserve currency. And I was kind of pointing out that it's sort of the opposite. And I know like people like Brent Johnson in the kind of macro YouTube space have talked about this a lot. The dollar milkshake theory is that it's sort of the opposite, and people don't understand this. It's like when the dollar goes down, it makes its role as a reserve currency easier than when it goes up. And that's basically what I'm talking about. It's like it's easier for the people who use the dollar as their reserve currency. It's easier for them to do that when the dollar is lower than when it's higher. Now, like as I've also talked before, that doesn't mean you want the dollar to like completely collapse. Like here's the dollar over the last like 60, 70 years. And so like if the dollar was to completely fall through like any support level way down here, I would start to be a little concerned. Like, you know, that back here, this was the run up of the great financial crisis, right? So like if it's falling completely out of its frame, that there's concern there. But going down within this kind of like larger long run channel, no, that's actually sort of potentially a good thing. And you can see here, like we've actually sort of been in an uptrend ever since that bottom of the financial crisis. And in many ways, that's been a strain to the global economy. So yeah, that's what I would say about that. Like the dollar's function in global markets is being reevaluated. That is for sure, but it's being reevaluated against gold, right? Like that's the thing that's really being reevaluated against, not against other currencies. You'll like because like gold as a percentage of total reserve assets, or gold as a percentage of FX reserves, or gold as a percentage of global M2 money supplier, whichever version of those ratios you want to come up with. I've seen a million charts of these online, and they all show the gold like going up and up and up. But the thing that tends to not take into account is that all of those take the price of gold into account. Like those are all using the dollar price of gold. So of course it looks parabolic. If you were to do the same thing where you just looked at units of dollars versus units of gold, which means ounces of gold, and just showed like which one was climbing more over time, it would be much less impressive. So like, again, that's not to say that that's not, like I said, not still a thing. I think that a lot of like central banks in many ways are actually trying to force the reevaluation of gold in terms of like the percentage of the assets. But again, it's like 2/3 to 3/4 of that move is price, and only like 1/4 to 1/3 of that move is the actual purchase, right? Like, so it's sort of like, you know, they're leveraging, and there's a multiplier effect on there. But yeah, so, and yeah, that's coming from like one of the big gold bulls. You know, I'm super bullish on gold in the context of all of this. In fact, that's a perfect segue kind of over to the next layer of sort of how I wanted to talk about. Because like in the context of that, yeah, it's like looking at gold has corrected pretty well with the market here, and in the context of the conflict. Obviously we had the big run up here in January, and I had done some pretty well timed trims, both in my gold kind of trading system and also in my long-term miner holdings back here. And then I have been adding more to my miner positions at various points throughout here. I added some in here, and I've definitely been adding some more in here into my select miner favorite positions. But we did have a big correction here in March, and I will say like my trading model for gold definitely did not perform super well around this. It didn't perform like super bad comparatively like to the actual assets themselves, but it basically just captured a lot of this negative return in the portfolio itself, which definitely sucked, but it wasn't unexpected in many ways. I've talked about this many times before. It's like gold responds well to massive amounts of liquidity. Like in many ways, that's about how gold prices in inflation, is because inflation is caused by excess amounts of liquidity above and beyond
productivity gains essentially. And so that liquidity finds a place to sit, and eventually it sits in this monetary rock called gold. So it's essentially just responding to the same thing inflation responds to, but on different time scales. And so that's why like gold works as an inflation hedge over the very long run. It doesn't work in the very short term or even really the midterm, but over the very long run, it works quite well as an inflation hedge because it's a monetary hedge. But the point is, that liquidity aspect, the way it's tied to liquidity, means that when you do have a drop in liquidity in financial markets, you do often have a big drop in gold. So the same time we were having this spike in the dollar and the drop in those various liquidity measures I was talking about, and the drop in the S&P 500, we also had a pretty precipitous drop in gold. And in many ways, it did okay. It did okay. Like all considered, what was like, I'm not even 100% sure, but the percent terms, we'll judge it from the beginning of March, not including that first drop, just like since the conflict began. It was as of end of day, it was like 16-17%. But at its lowest point, it was like 22-23%. So very, very significant drops there at its lowest point. But in many ways, you can see it came back down to kind of somewhat of a support like level. So that's pretty good of a sign that it showed it came back to support, retested, and came back up. And if you're kind of like looking at like the the chart stuff, so to speak. And also I did kind of want to point out that there is also, coming over to the CBO tool and looking at metals, and it's like this is implied volatility for gold. You can see back here that first initial spike up we're talking about where I was initially took off a lot of my positions, and then gold came back down here, and then here's March where it started to tumble a little bit, and then we had the big spike up, which is where we had those biggest largest tumbles, and then this is actually kind of where the bottom was. So implied volatility, as with implied volatility, works in the SPY, as with gold, it also does a similar thing where it will also be of a good timing of bottom. So here, because the implied volatility was still pretty high when it bottomed and was at that kind of support level, and it started to come down. Though it's worth noting that we're still somewhat at a somewhat elevated level. And was this 1 year? That was like 6 months. So this is the over 1 year, 3 years, 5 years, right? So like even here, where the implied volatility for gold is now down to 27.28, which is much lower than it's been basically since the start of the year, but it's still much higher than it's been for the last 5 years. And like you're going back to the last 12 years, the entire history we have for the implied gold volatility. So kind of looking within that, this makes me feel pretty good about gold still. It means that I think that fears priced in. A lot of the weak hands were shook out, and fears reasonably priced in. And then on that front also, because like they have the volatility information here, but there's also the skew ratio that can be looked at. Again, looking at just gold last year. The skew ratio, which is calls versus puts, right? So 3 years, 5 years, or really just all. Here's the one line. So you can see, generally speaking, the line is above 1, right? Like the line is like the vast majority of the time above 1, which means usually there's more calls than puts for gold. And then coming in, zooming in here, you can see it's come back up above 1s in the last couple of days here, but we're only just barely above 1, so we're still below the average on that. So kind of like looking at like all those different positioning metrics within gold, it does make me feel pretty good about gold. It did as expected have a pretty big decline when the liquidity dropped out of the market, but for the most part it has stabilized pretty well. And like we could definitely have like a secondary liquidity flush. It wouldn't shock me if we did, but I bet in many ways, like even if it did came below support, it would probably, like, I think quickly scoot back above that, but both because one, just like I said, the kind of like midterm, long-term dynamics involved in gold liquidity, the long-term perspective for it, but then those short-term dynamics around the skew ratio and implied volatility both look pretty good for that. And also, actually, while I'm here, because the same data also gives you the same thing for oil. We can look at literally the same thing for WTI. So here's implied volatility for the last year in WTI. So yeah, 94, way high for 1 year, 3 years, 5 years, all time. So yeah, we're higher implied volatility for oil ever, except for 2020, right? So and think about what was happening in 2020, right? And obviously, a lot of people say that depending on how long this dynamic goes on, and how poor certain mitigation effects could be, that this could be a similar type supply constraint. And there's certainly strong arguments for that. I'm not trying to belay that at all. Getting back around to like the earlier stuff I was talking about with when we were kind of comparing the wheat prices and commodity prices generally, and all the earlier discussion about that. But looking at this here, yeah. So point is, this pricing, keeping this pricing in mind though, this is what is currently priced into the market, is that extreme level of volatility, right? And then zooming in again, looking at the skew ratio, which looks at calls versus puts, and again looking at just the WTI for that for the last year. Calls versus puts, 3 years, 5 years, all time. Now with gold, I was looking at calls versus puts and I wanted it to be low because that meant that there was a high amount of puts, because I didn't want gold to go down. And if puts were priced in, that means it was going to be harder for it to go down. So here with oil, we don't want it to go up. So it's the opposite, right? So that means here you can see that there is, what is it currently? 1.5, 1.65. There's currently 65% more calls than there are puts on oil, when the all-time, you can see, generally speaking, it's hung out around 1. So we have a huge amounts of bets. That basically means that there's a massive amounts of bets on the skew. So the huge amount of positioning in the bets, and the pricing, which is what the implied volatility is, and the pricing of those bets are to the extreme. So it's not impossible that oil goes higher. As I talked about before, when I was looking at oil prices, I gave you dynamics about how what could or would happen if oil prices were to double from here. Like, we certainly could have dynamics when that occurred. But the point of me showing you here the implied volatility and the skew ratio is to show you that that's actually going to be very difficult to do because of how it's being priced into the markets. This puts a ceiling on the prices in the short term. Basically, everyone's already like all into one side of the boat in terms of the positioning for that. So like I said, well, we could definitely have some big happenings in terms of what happens with the conflicts that could get us there. But in the short term, medium term, I think it's actually far more likely that oil prices go down than up. And it's far more likely that gold prices go up than down when looking in the context of all those things together. So yeah, that's that. So we did, okay, so cool. We did get through most of the stuff I wanted to talk about with liquidity. And we did talk a lot about gold. I did want to talk about gold miners. And then I also said I want to talk about credit conditions. We'll maybe save credit conditions for the next show. But we'll talk briefly about gold miners, not a ton about it. Just kind of little brief updates. One is that one of my favorite gold miners, which was New Gold, they were going through a merger with Coeur, and that completed here in the first quarter. So that has finalized Coeur Mining, which I know I had talked about when they first announced this. I know I had said that I was here. Actually, let me go pull up their little presentation thing. I know when they first announced me, I said I was kind of disappointed in the merger because it just didn't seem like it was going to do everything I wanted for it. And specifically, what my issue was is that New Gold, I liked New Gold a lot because they had very high ASIC margins for their gold. They were a complete North American gold miner, and they only had a couple mines, which means that I could look at them very closely in a high detail and model them out carefully. And also, I really liked the management team too. I thought the management team was really good. And then they had like net cash positions. They were really good gold miner on many levels. But the one problem with New Gold was that they had a very short life of mine. They didn't really have a huge amount of years left in their overall mine profile. And so essentially I needed them to use the massive amounts of cash flow that they were going to bring in to either A, acquire new assets, or B, do massive amounts of buybacks or special dividends to essentially make the capital return profile strong enough to counteract the fact that you didn't really have a terminal value. Because the stock traded for a really tiny multiple because it didn't have that terminal value, because it didn't have long life of mine. And so, like I said, like you needed to do something in the long term. Basically, it's like you either needed to pump all that cash flow into the earnings per share to cause the stock to rise regardless, or you needed to pay out massive special dividends to make people take up positions to wait for it, or you needed to make a deal. And they did make a deal, but when I looked at the company that they were making the deal with, which was Coair Mining, it looked to me like they basically had the same life of mines. So it wasn't really an improvement on that terminal value scenario, in my opinion. Like you basically just increased the total production of the mining company, and kept great margins, and it was still mostly North America, so they didn't really break that issue either. So like it was a good company, like it was a good company to combine with, but it was still a company that basically had that same core issue, which is that they had a very short amount of time in which they would be earning massive amounts of cash flow. And I wanted them to turn that into a kind of a more long-term asset. So that was my initial issue when they first announced it. But I will say now that they've completed it, and I did downside my position when they announced it, because they did have significant pop, and this was also during those kind of like high points of the gold prices in like, it was like, I think it was December when they first announced it, so it was like January when I was unloading my position a bit on them. And here I'll pull this up here. This is kind of an estimated weighted amount of my gold mining position. It has my 4 miners roughly weighted by the shares in which they're in my portfolio. Just a rough estimate. So this gives you a rough estimate of like what my mining position has performed like. Let's actually compare that with gold, I guess. Why not? Put it on its own scale though. Actually, we'll leave this as percentage since the number doesn't really mean anything. So you can see it's mostly just tracked gold for the time period, which has to do partially with those low terminal multiples. Actually, or at least on a couple of them, because that issue exists for Coair Mining / New Gold, but it also existed for Silvercorp to a certain extent, but it doesn't exist for Equinox and Orla to the same extent. So anyway, coming back over to the presentation, point is they did finally combine the company, and then they released all the information regarding their production profile and what they plan to do for 2026, updated with the merger, and also an updated list of all of their assets. And I think maybe I just had missed a complete understanding of like all of their reserves and their assets or something when I first looked at it, because it definitely is an improvement on the total life of mine compared to what New Gold had. It's not a super improvement, but it is an improvement nonetheless. And so long way to say that I've started adding to that Coair position. Like I said, I had kind of downsided the New Gold position, and then it transferred into the Coair position. And then, as I said, I've been adding to my miners, but Coair is definitely one of the ones that I'm focusing on. So here, let me see. Is this the new one? I think this is the new one. But yeah, so they have, let's see, New Afton and Rainy River. Those are the 2 mines that New Gold had, but they also have Las Chipas, Parameo, Rochester, Kensington, Wharf. So that's, what is that? 7, 1, 2, 3, 4, 5, 6, 7. 7 mines. When previously New Gold just had 2 mines, so it's now a 7 mine project, all of which are in North or Central America, which is still largely a preferable kind of geographic range. And then as you can see here, I've modeled out basically the next 10 years for them. This is kind of like where I've modeled out pretty much their entire financial profile largely. But they do have years left over. So that's the thing, is like New Gold largely only had like 9 to 10 years worth of active mine life, which means you basically just had like your 10-year projection period, but there wasn't really any terminal value whatsoever. Whereas the combined Coair New Gold has, what is it in total? 10 plus then about 7.5 weighted years worth of active life that'll still exist after the 10 years. So 17.5 in total. So that means the way I like to kind of like turn that into a terminal value is like kind of imply a certain weighted expected return on that. And so that gives me like a terminal multiple of maybe like a 5 on there. So that's not too bad. So either way, pretty happy with that. That's pretty good. The valuation itself is not necessarily super amazing. So like if I come over and show you what I've gotten there for that, I mean, pretty strong revenues, and this is based off of the current gold price. I'm just assuming the current gold price through the entire time frame and the current silver price. It's worth noting. That's kind of how I'm handling my gold valuations these days. So I just kind of like use that and allow the discounting of future gold prices to be part of the discounting of the future expected returns in the valuation. So with that in mind, if we had today's gold price and today's silver price forever, basically, then it would be approximately 14% overvalued, which is, not too bad. And then nonetheless, you would still have maybe like 10% expected returns, even with being 14% overvalued. But then, like I said, you kind of want to take that in context of the gold price, because, it's like, okay, 14% overvalued with today's gold price, but do I think today's gold price could be 14% higher? Yeah, I definitely think it could. So doesn't mean I'm gonna sell dramatically. And like I said, in fact, I was buying some like 10% ago, so when it was basically about fair value or so. Yeah, that's where we are with that. Which yeah, because you'll hear me say that. I will say a lot more these days compared to like how I used to be in the past. Is like I make a lot of my evaluations using a lot more conservative assumptions in a lot of ways nowadays. So a lot of times you'll hear me say I'm buying something around fair value, but a lot of times I know I'm saying that in the context of like really, really conservative assumptions that, I know basically means that the expected returns are actually probably high, even if the fair value upside isn't high under those assumptions, right? Because it's usually sort of like one or the two. It's like there's a trade-off there. It's like you can make the fair value very high, but then you're making the expected returns lower. But then you can make the fair value lower, but then have the expected returns high. And basically what you're doing there is you're just changing the discount rate of what fair value is. So which is kind of like a in the abstract, academic sense, that basically is an expression of your confidence in the cash flows, right? Which people call risk, which, sort of arbitrary in many ways, the discounting mechanism. So anyway, that's kind of what's going on with that gold miner position. It's now turned into co-air mining, but we're pretty happy with it. Coming over to my actual portfolio, what is it? It's only like 1% of my portfolio co-air by itself. My gold miners, all four of them together, is 7.3% of my portfolio combined. And then obviously I have a large position in gold as well. I'm looking at the commodity exposure. Yeah, I'm like a quarter in gold right now, but my model is tilted toward gold currently. So that is definitely a little an overweighting as of the current week. And then my gold, silver, and other materials positions. So looking at a lot of other positions, like I know I haven't talked a whole ton about new evaluations as much in the last like handful of months. I've definitely added a bunch of companies into this list here, and some of them are kind of interesting, and I just haven't talked about them a whole ton. Like for example, if I just list here by upside, then you can see like, for example, Corn Ferry, I see significant upside in. I think it's kind of an interesting one. That's a consulting company that does a lot of like the similar executive search stuff that Heidrick and Struggles did, for example. But unfortunately for Corn Ferry, that's like, I think it's like 5 to 10% of their revenue. So it's really like a small portion of their business compared to Heidrick and Struggles, unfortunately. So it's just not a pure play, but they do other consulting stuff. And they are on discount right now because they, along with many other consulting companies that often are selling software packages along with their consulting, means that they've been kind of dragged under with a lot of the AI negative to software narrative. A lot of consulting companies have been hit at the same time as that for kind of being in somewhat related businesses and selling somewhat related products. So Corn Ferry's been hit for that reason. I haven't necessarily done super like deep analysis on that, so take that for a grain of salt. But it is potentially interesting and one that I've been kind of keeping an eye on. Uber, I know I've talked about that one at least a little bit more and showing like kind of the assumptions around my valuation for. But I did actually do like a full model for the revenues for, so that I actually feel reasonably confident on that one for like as a long-term position. And I know I still didn't even really go into that one in depth, and I'm not going to do that here today, but I do think about that, the fact that I never did show you guys the full model, and so I do kind of want to do that eventually at some point. And then I've done some other ones. I've looked a lot more closely again at the gold royalty companies, Osisco Royalties, and Royal Gold, and I actually took a position in Royal Gold, and have been holding that one a little bit for the time being. So that's technically a fifth gold mining position that's been added to the kind of rotation. But that one's a little bit different of one. So that's kind of in there. And both of those are kind of priced probably cheap relative to their potential. But then other ones, I've funnily enough, I've looked recently at Circle Internet Group, for a variety of reasons. I've heard of an actually very, very strong, compelling bull case for them for the long run. And I mean, obviously, if you go look at like their estimates, they have like massive growth estimates already baked in. So it's not like hearing somebody's bull case is like, oh well, I've never heard a compelling bull case for the business of Circle, but one that at least I guess you could say spoke to me a little bit stronger. And like I said, I'm not going to really go over that in depth here today, but the point is I did do a valuation for them, and yeah, there's like massive growth baked into this valuation, but nonetheless, I was at least able to reconcile a fair value for them, as you can see right here at they're currently $88, and I can see them at least as sort of like potentially like a fair value sort of thing. But again, massive growth baked into that. So it's like you would probably want to even have a significant discount there. And although, like I said, like it depends on what you assume about the future, because like I said, I did do some kind of like simple modeling on how you would get massive growth for them, and in terms of like what they're doing as an industry. And it's hard to estimate. That's all I'll say about that. It's like one of those things where it's like I could see huge growth, but like it could be multiples of what I actually assumed. So that's what I say. And also like the competition part, like I said, we'll talk about that one another day. But the point is like that's a strange growth play that I was somewhat, I guess you could say, convinced of at least the likelihood that they would probably be very successful. Doesn't mean that they're a great investment, the stock, but I've at least been bought into the fundamental case for the company. And then I would say it's also basically the same thing for this company here. Hyperliquid Strategies is another one, kind of somewhat similar, but also different. Like it's a somewhat similar type of bull case that I've been convinced of, that like I ran some numbers on and was like, oh, that's kind of interesting. But both of which require relying on massive growth assumptions. Neither of which have I taken positions on yet, but both of them were interesting enough that I'm like, oh wow, I kind of want to look into that further, if for no other reason than it was at least just kind of curious. But like I said, we'll probably talk more about those ones in the future. Just I at least wanted to put those on the radar, because those ones are definitely, I would say, outside of the norm of types of companies I would normally look at. But I think they could be potentially very interesting multi-baggers. That's all I'm saying. Like I think both of them have potentially interesting multi-bagger potential around them, depending on what you assume about their industry. But other companies I've done recently, Dassault Systems, that's a European software and tech company that does a lot of defense spending. That also been caught up in the AI declines, but because of their relation to European defense, I think that maybe you could look at them as potentially a more safe kind of systems kind of play. I haven't looked at them in super in depth, and like I said, depends on the assumptions you put on them here. But interesting companies. But yeah, so I have definitely done a whole lot of little like side little valuations, as you can see here, that I've added in here. I just haven't done like super deep research into most of them, and I have been kind of putting together lists related to a variety of themes that I want to look into a lot more. So like kind of just talking about some of them here, AI integratable software, systems of record softwares. And many of these themes are ones that obviously many people are talking about. These aren't necessarily like super novel things I just came up with or whatever, but drone warfare, robotics, automation, gold mining, copper deficit, aluminum deficit, data center construction, power grid weakness, oil, gas equipment servicing, rental properties, end of life / inheritance, employment / job search, home building, home improvement, railroads, users of AI, hedgings of AI, domestic natural gas users, pension transfers, non-PC, non-private credit, private equity, deal makers, finance, and the space race. So like I said, maybe we'll get into the depth of what maybe companies would fall in each of those categories in future shows. And I would appreciate your own inputs on those, either themes that you guys are interested in, or if any of those speak to any of you guys and you have companies to throw at any of those, throw them at me, throw them in the comments, all that jazz, or anything else, or just any companies out there that you think are super cheap that you would like me to maybe take a look at, throw them my way. But anyway, that's going to do it for today. like I said, we didn't get around to really talking about the credit cycle and credit conditions. We'll maybe save that for another show. But I didn't want to do a super long show today. I know I've done some longer shows in the last couple times, but anyway, I'll catch you all again, hopefully in 2 weeks. All right.